Hello listeners and welcome to the show. This is Sam Abrika, the CEO of Nova Money, an AI financial planner designed to help you build financial freedom. In today's episode, we will learn about the reality of mortgages and how tricky they can be by hearing the story of Jinesh, an ex-Goldman Sachs banker. Just like me, Jinesh hates debt. He hates debt so much that the reason he left investment banking is to launch Sprive, a new mobile app to help homeowners pay off their mortgages faster and become debt-free. Hello Jinesh and welcome to the show.
Hi, thanks for having me, Sam.
My pleasure. So today we're going to talk about mortgages because Jinesh, from what I understand, you don't like mortgages and you made it your business to help people become debt-free and repay all their mortgage debt.
That's right. I mean, I paid off my own mortgage and my life is completely changed because of it. And so I'm just passionate about helping other people do the same.
So before getting a mortgage, how did you get your first house?
So I actually lived at home for until I was about the age of 28. So I was quite lucky. I saved up quite a lot of money. I didn't have to pay any rent. And when I got married, my wife and I decided that we wanted to buy our first home. So we started looking around and used the savings that we'd essentially accumulated since we started work. And we bought our first property with a 25% deposit.
So that was your hack, living with your parents until the age of 28.
Yeah, exactly. It doesn't sound very cool, but it really did help us get a kind of solid foundation. I think culturally...
but it's very pragmatic.
Yeah, no, and it works. I think a lot more people are doing it. I think culturally it's quite normal. I come from an Indian heritage, and so it's not uncommon. But I worked in central London. My family lives in London, and I just felt like it made no sense for me to move out. I get on very well with my parents, so it was just a really good fit.
I used to work also in the investment banking industry, living in the central London, working in the city. And although in the investment banking, we were paid quite well, housing in London was unaffordable, even to bankers.
Yeah, I completely agree. I think even my first home that we bought it outside London because the property prices are so expensive. I couldn't afford a house in London. So we've actually bought a 5-bedroom house in Hertfordshire and Bushey.
So the only solution when we can't afford something is, get into debt to buy it. And that's how people get into the business of mortgages.
That's exactly right.
So how did you get yours?
Yeah, so when we just first decided, okay, we want to buy our first home, we worked out on paper how much we could put down as a deposit. And we knew we had to borrow in total over £300,000. So quite a fair chunk of cash. And so we started talking to brokers. I didn't know any mortgage broker. I was in investment banking. I wasn't in mortgages at the time. So I asked some friends and family of any kind of good mortgage brokers that they knew, any good advisors. They recommended a few and I went to see them. And quite quickly, I kind of got a sense of what type of mortgage product I wanted, what was out there, what was like the best deal that I probably could get in the market. And then when I spoke to the mortgage advisors, they started saying, yeah, we can help you get that mortgage, but there's a fee that you need to pay. And I was a little bit confused. I was like, don't you get paid commission by the mortgage lender? Why are you charging me fees? And so I ended up just going directly to the lender and applying for a mortgage and filling in tons of paperwork to make that happen.
Today, if people want a mortgage, basically there are three options. Either you go through a broker, either you go directly to the bank, just like you ended up doing, or you can go to the comparators. And there are a couple of comparators that will kind of tell you what are all your options and rank you the cheapest mortgage providers. Why not going through a comparator?
Comparison site?
Yeah, like all these websites, that's Money Supermarket, etc.
Yeah, so what I don't like about the comparison sites is they show you lots of deals, but they don't necessarily tell you whether you can actually be eligible for that deal. So they don't look at your affordability typically. They don't look at your credit history. They obviously don't provide advice. You're not really talking to a human being. And once you've gone through that process, typically what happens is you then have to submit all the paperwork yourself using they essentially just route you to the lender's website. So I found that quite tough. And when you're buying your first property, you really want to be looked after. You want to make sure that you know exactly what you're doing. And I felt that, using something like a comparison site was just a little bit tough. I may have used it when I was looking to remortgage, but for my first purchase, I mean, think about it, it's probably the most expensive thing you'll ever purchase. So, either using an advisor or at least having the support of the lender, which is, we went into a branch, we spoke to someone, they walked us through the process. They even helped us fill in some of the application forms. We were just handheld and they just gave us a lot more comfort.
And how was the user experience?
I think with the broker, when I first met them, I was a little bit shocked in terms of how antiquated the whole process was. So I remember sitting down with the advisor and he had a piece of paper and he'd asked me lots of questions that were very personal to me about how much I earn, spending, credit commitments, the rest of it. And he was just writing it down on a piece of paper. And I was thinking from a GDPR perspective, this isn't, at all kind of secure or safe. And I imagine he's got my personal information somewhere on a Word document and there's no technology, there's no security whatsoever. So I remember that process being quite interesting. We spoke to a few different brokers and eventually we learned a lot from them, but I also struggled to find out what a good broker looked like. So when I asked my friends, they were like, well, yeah, we know this person, but how do you know if they're any good? Because they just tell you this is the product that you should go for, but how do you know that's the cheapest deal? You're essentially taking it on blind faith. So I actually learned a lot through that process, even just kind of taking that experience and applying it to my own business now. In terms of when I went to the lender, first of all, we had to book an appointment. So you have to take time out of work, which is obviously painful, especially when you're investment banking and you're working long hours. And then once you go see them, lots of questions, 2-hour, 3-hour appointments, lots of online paperwork, very manual. If you've ever filled out a mortgage application form, I think it's 150 questions. And I was thinking in this day and age, does it need to take that long? So it was a very cumbersome process. I think there's a lot more room, especially with technology that we have at our disposal, to make that a lot more streamlined. And that's where kind of Sprive is coming in. And we're looking at, using things like open banking and other technologies to make it a lot more efficient.
Yeah, the mortgage industry, let's say, is not the most innovative one so far. And I've looked at this space. Actually, the reason is every bank, they have their own set of questions that they want to know before assessing people for mortgages. And everyone will formulate their questions in their own way. And they don't want to agree and they don't want to standardize, although they might ask exactly the same thing. For example, how old are you? And another bank will ask you, what's your date of birth? But obviously, when everybody has a different format and they ask you picture in different format, then you need to redo all of that. So why do you think it's still such a painful process today to apply for a mortgage?
Yeah, I think you're right. There's about 100 plus lenders out there in the market. And you've obviously you've got the main players. I think there's 6 largest lenders that have 80% of the market share. And they all have their own underwriting process. They all have their way of determining whether an individual can afford the mortgage. What's the risk? What's the likelihood of them defaulting? Can they afford the monthly payments? And they have built these technology systems to manage this whole process that is 20 years old. And because
At best,
yeah. And they've not needed to, it works. And they've not needed to really, put money behind it until now. I think they're starting to realize with the likes of Habito and Trussell and other digital players coming in, and more people are looking for faster, more efficient solutions. And so, you're starting to see change. There are industry forums I'm also kind of linked with where they're trying to create better integration and better automation. And so you will see that change happen over time, but it's expensive and it does take a while. And so, yeah, you're right. The mortgage industry is very traditional. It's one of the last, I say, financial services sector to really be kind of disrupted and transformed.
So since you're in the space and you have been through the process both as a customer and now as an entrepreneur, can you walk us through What are the steps to get approved for a mortgage? How does it work when you're talking to a mortgage broker? And what kind of questions, how do they assess our financial health?
Yeah, sure. So I think the first thing they want to know is a little bit about your affordability. So when you go meet a mortgage advisor, they will kind of want to understand what kind of property are you looking to buy, kind of value, in terms of, because that's going to determine how much you need to borrow. And very quickly, how much of a deposit can you put down? And that really determines your loan to value, which is the first kind of data point that is really key to determine what kind of mortgage deal you could even get. The larger the deposit you can put down, the cheaper the mortgage deal that you'll be able to, acquire. And they'll look at things like your credit commitments. So do you have credit card debt? Do you have student loan debt? What's your regular outgoings? They'll even look at things like, do you gamble? Because if you gamble, then that potentially might be a red flag that, you might have some money, you might gamble it away and so not be able to pay your monthly payments. And so very much the first step is an affordability check.
I'm very curious. How do they look for gamblers? How do they catch gamblers?
So the old school way is the advisor would get copies of your statements. So at least 3 months worth of history. And the advisor will be looking through and scanning your transactions to kind of see if you've got any kind of gambling activity. Likewise, that information you submit to the lenders itself. So they will do their due diligence as well. And so that's kind of one of the red flags that they look for. They even look at things like, do you have a credit file? Are you on the electoral register? Et cetera, et cetera. So they all have bespoke models, but that's typically the number one thing they're looking for is trying to understand the risk exposure. And if you're self-employed and your income is, say, for example, harder to prove, then it's typically harder to get a mortgage.
And you know how they use the credit score and how they use your own personal financial situation to assess your creditworthiness and your risk of default?
I think in terms of like how the actual model works, or just, typically.
Oh, no, just how they use like the credit score and to which extent credit score matters to get approved for a mortgage.
I think it's, first of all, it's when you've determined your loan to value, like how much you can actually afford, you'll get a very clear idea on what your monthly payments will be. And so if you've got enough income coming in, you've got a stable job, stable income, and there's a decent amount of gap between the amount you need to pay on your monthly mortgage versus the income that's coming in, then your credit score doesn't matter as much. It's very clear to the lender that you can afford this property. It becomes a lot more important when it's a lot tighter in terms of your ability to demonstrate that you can afford this mortgage. And then they will look a lot more closely at your credit history, at your credit file, and at your credit score. If you've shown a history of being able to take debt and then pay it off, so you have a good credit history, then that will result in you having a good credit score, and that will give the lender confidence. If you've had a credit card for the last 5-10 years and you've shown that you've always been able to pay off your debts and meet your commitments, then it gives the lender confidence that, their past history shows that they will, likely meet the monthly payments. However, if you see, you've got adverse credit history, you've got a history of bankruptcy, default, not paying other debts that you may have taken in the past, then that's going to work against you. And that's going to probably reduce the likelihood of you being able to secure that mortgage, or at least be a lot more difficult.
Okay. How did it work when you tried to negotiate the interest rate of your mortgages? Did you have like any tips, any key criteria, for example, like saying, oh, look, I have a stable job, I have a high income?
I think the biggest thing you can do to, if you want to pay less interest, is put down a bigger deposit. It's a real balance because you buy a home, but the costs don't stop there. There's other fees that you need to pay. Conveyancing fees and arrangement fees and whatnot. And then obviously the stamp duty, once you buy your property, typically you want to do something to it. You need to buy furniture. You might want to knock a wall down, do some other work to it, especially if it's not a new build. And so you got to budget for all of that. And at the same time, I was very keen to make sure that I had enough money for a rainy day. You never know what can happen. The last year has been a good example. COVID happened. People unfortunately lost their jobs, etc., or weren't earning any income for a good amount of time. So you want to try to make that deposit as large as possible, because the better loan to value that you have, that means the cheapest interest rate you can get. There's other things you can do. So fixed mortgage versus a flexible mortgage, a variable mortgage. Typically, you pay a slightly higher premium for having a fixed mortgage than a variable mortgage. So that's another way of maybe getting a slightly lower interest rate upfront.
So let's talk about that, because that's something that is extremely common in the banking to talk about fixed rate, floating rate. But for most people, it's quite obscure. So could you tell us, like, how does it work, the fixed mortgage and the floating rate, and which one would you recommend to whom?
Okay, I think every different individuals, their circumstances will depend on whether a fixed is best or whether a variable mortgage is better, floating mortgage. I'll probably start off just by kind of, for everyone's benefit, explaining what they are. So a fixed mortgage typically means that you pay an interest rate over a certain period. So you may get a 2-year fixed product, or 3-year or 5-year fixed. You can even get 40-year fixed mortgages now. And that essentially means that you'll pay the same interest rate throughout that entire period. And the benefit of that is that means your monthly payments will remain the same. And so you get a lot more confidence, especially if you're someone who likes to budget and you don't like the amount of debt that you need to pay each month to be unpredictable. Then a fixed mortgage could be quite good for you. The other thing is, if you think interest rates are going to go up, and at the moment interest rates are very low, and I think the Bank of England recently announced that they don't have any plans to reduce the Bank of England base rate, then you might think that actually, why don't I just fix it now? Because, if interest rates were going to rise, then at least I'm protected against that. The downside of having a fixed mortgage is that typically there's higher exit fees. So all the time there's new lenders coming out, there's new products coming out. So if you wanted to leave, you'd probably pay higher exit fees. And so you're essentially more locked in for longer. With flexible mortgage and variable mortgages, you're paying a lower interest rate generally because you're paying a premium for fixing the rate. And if the interest rates does go up, like the Bank of England kind of base rate goes up, then you'll pay a higher interest rate. So you've got to be careful with a variable mortgage, because if you're paying X a month and the interest rates do start to rise, you need to make sure that you can still afford those rising monthly payments. So there's an extra element of risk, but there's also extra flexibility with that. So say, for example, you are overpaying on your mortgage and you're paying off your mortgage faster, you might find yourself that within your deal period, you're actually reducing your loan to value and you're actually eligible to more cheaper deals in the market. But because you have a kind of a floating mortgage, it might mean that actually it's better for you to exit early and get a cheaper deal, and you save even more interest rate, and you just adjust it against the early fees that you need to pay. So there's pros and cons. I think that my steer would be that you sit down with an FCA regulated financial advisor if you're not sure, and just talk through the options.
The floating rate mortgages was something that was really quite dangerous in the last financial crisis, because there were a lot of people, they had a mortgage, they could pay it off during what we call like normal market condition, when everything goes fine. But then they had mortgages where the amount of interest was indexed on a foreign currency. So for example, a lot of people in Central and Eastern Europe, they had mortgages denominated and indexed to the dollar or the CHF, which means when the interest rate was increasing and when their currency was being devaluated against the dollars and the CHF, then their monthly payment could increase by 30, 50, 60%. And that's how a lot of people have defaulted during the last financial crisis. But fortunately, in the UK, the regulation kind of protects consumers to limit the risk of the floating interest rate. Everything is still denominated in pound, and actually it's floating, but quite often it remains constant for, let's say, 1 year or 2 years, right?
Yeah, I think the UK is typically pegged against the Bank of England base rate, so that makes it a lot less risky compared to some of the other countries that you've talked about. I mean, you asked me, what do I prefer? When I had a mortgage, I preferred getting floating mortgages. I like the flexibility. Who knows what's going to happen in 5 years' time? So I like to be able to shop around every couple of years. My personal situation may change. Some people may, when they're getting their first home, might be single and buy a property alone, and suddenly they get married, and that changes their financial circumstances, etc. So I like to keep my options open. I understand a lot of people at the moment are getting fixed mortgages. 5-year fixed mortgages are very popular.
That's a very good point. Mortgages are typically quite long contract. It's like typically the biggest financial commitment that somebody would take in their life. So how flexible is it? Because as you said, in 5 years, your life might be completely different. You might have a promotion, you might do something else, or you may take a sabbatical year. So how easy it is to change the mortgages, to increase the payment, to decrease the payment, to repay it early, etc.?
So I think it varies from product to product and lender to lender. Some lenders have very, very flexible mortgages, some less so. A lot of the features around mortgages aren't very transparent. So you mentioned like paying off your mortgage faster. That's quite common. So I think it's estimated nearly half of homeowners in the UK at some point in their life have made mortgage overpayments. And mortgage overpayments is simply paying more than your minimum monthly payment that you're committed to make. And like most lenders in the market will allow you to pay up to 10% of the outstanding value that you borrowed. So if you borrowed £300,000, you would be allowed to overpay in a single year £30,000 or less, which is a lot of money. So that's great. But the lenders typically don't necessarily promote that they allow you to do this. And so a lot of it you have to kind of work out for yourself. A lot of lenders, when it comes to overpayments, they have two modes. So you can make an overpayment, and default typically is it reduces your monthly payments. A lot of people go, that's so great. Every month I need to pay less, but what you don't realize is actually you end up paying more interest. You don't actually pay off your mortgage earlier compared to if you made overpayments and you picked up the phone and you notified them that actually you want your monthly payments to have the effect of reducing your term. So what that does is that it keeps your monthly payments the same, but essentially paying off the amount that you originally borrowed. And because you're now essentially owe the lender less, you end up paying less interest than you pay off your mortgage earlier. And actually I made that mistake. So you might think, with my background in financial services at Goldman Sachs, that I'm really savvy with these things. And I thought I was being smart because I had this goal when we got our mortgage. I sat down with my wife and I was like, I want to pay this thing off. And we set a 5-year goal to essentially get rid of it. And so we started making overpayments, thinking it's simple as doing a third-party payment to your mortgage account, and you start saving interest and paying it off earlier. And it was only probably about a year into the process that I realized that my monthly payments were going down, but I actually wasn't saving as much interest as I thought I should be. And so when I started to contact the lender, I realized that actually I need to tell them. And so even then, that was a simple mistake that I made. So
I think many people would make this mistake.
Yeah, I think they do, and I think they a lot of people are also scared off by the whole concept of early repayment charges. No one wants to be charged for doing something that ultimately might make them be in a better financial position. And so even though the limits can be quite large, some people are just mentally put off by that word, and it's often not very transparent and it's often quite complicated, and you have to read the small print in the mortgage offer document to understand exactly what you can do and what you can't do. And even the exit penalties, people feel like that they can't leave even though they're within a mortgage period. And so even when they're within their deal period, they are resigned to the fact that they're stuck there until their deal expires. And in reality, if you look carefully, that it might make sense for you to leave early. It's just you got to do the maths, and that's obviously time consuming and not easy, especially because you don't know what other deals are available in the market.
Yeah, paying off the mortgage early might sound like a wise decision, but why do you think it's made so complicated with so little transparency of what are your options as a consumer, as a mortgage client, of if you repay X, that will be that much interest rate, that much monthly payment, and this is the impact for the next 15 years, the remaining of your contract? Why is it so complicated?
Well, I think if you go to most lenders' website, you'll see a mortgage overpayment calculator. They'll tell you, like, if you make X or Y or Z overpayment, that this is the benefit. So they do have the tools, but they don't have it necessarily where you want them. So very few banking apps that will show you, here's, press this button and suddenly you'll start making overpayments. And very rarely do they show you the benefits of making overpayments where it really matters. So I remember when I was making mortgage overpayments, I didn't know how much interest I was saving. I didn't really know if I was on track to pay off my mortgage 8 years earlier, 9 years earlier, 10 years earlier. All I knew is that I'm doing something to achieve a goal. And if I keep doing this long enough, eventually my annual mortgage statement will come and that number will be zero. But you got to think about it from a lender's perspective. They're in the business of making money. They have obviously shareholders, etc. The longer people have mortgages, the more money they make. Typically, lenders also front load interest payments. So there's this whole concept of amortization. So at the earlier years of your mortgage, you're paying mostly interest, and then later in life, you're paying less interest. And you obviously understand from why they do that, from a risk perspective, as well as, obviously the more you have outstanding, the more interest you're going to pay. What you typically find is most people in the UK, they wait until later in life. So when they're in their 50s or in their 60s, and they suddenly realize that, okay, I'm approaching retirement. I don't really want to have this mortgage and have these monthly payments because then I need to make sure I'm earning. So they start paying it off. But that's fine because lenders are okay with that because they've got most of the interest in the earlier years of your mortgage.
They made their money.
Yeah, they made their money. And so it doesn't make business sense to help people pay off their debt. And for someone like Sprive, I think it creates a real gap because we're on the side of the consumer. Our job is to say, you've taken the largest household commitment of your life. You're going to end up paying tens, if not hundreds of thousands of pounds in interest over your lifetime. Why wait till late in life and let the lender essentially win? Why don't you just, put your spare cash? It doesn't have to be a lot. Even if you can afford £3 a day, the amount of impact it can have in terms of how much interest you can save and how much quicker you can pay off your mortgage is amazing. I mean, even just now, we haven't publicly launched yet, but the existing user base that we have, they're on track to pay off their mortgage 8 years earlier and save £32,000 in interest on average, which is quite a sizable sum. So, it just shows if you're continually at it, it can make a huge dent and a huge impact.
That's impressive. And why do you think they can repay it 8 years earlier? Is it because that their income has increased a lot since the day they signed the mortgage?
Yeah, so I wouldn't say their income's necessarily increased a lot. I think the typical profile of our customers is they've bought their first home and they've obviously got to a position where they've probably a year old getting that property and they're comfortable. They're financially not worried about meeting the monthly payments. They have enough income coming in, whether it's through one member of the family or whether it's two people both earning, partners earning and being able to afford. And so then they've got discretionary income each month and it's for them to decide what they want to do with that cash. And some people spend it. Some people, want to invest and spend, and some people want to save. And so what we found with our customers is a lot of them just don't like the idea of having a mortgage later in life. They want more control. They also realize that interest rates are low. So just keeping money at their bank account, they're earning very little in terms of interest. And the great thing about paying off your mortgage is that it's a liability, it's debt. So essentially it's tax free. If you've got money sitting in your savings account, not only do you earn very little interest on it, but if you're higher, you're also paying tax on it. And so a lot of people are thinking, well, I've got the benefit of paying off my mortgage earlier, more control over my life, but I'm also saving more money. And they really like the idea of that. And we find some people are very aggressive. So some people are a little bit like myself, where they set like a 5-year goal or a 10-year goal or 15-year goal, and they just want to get rid of it as quickly as they can. And obviously the more income they have, the more they can do it. And some people do a bit of both. They want something to chip away. So when they look at their mortgage, they're like, at the moment, I've got a 40-year mortgage. So if I keep things and just pay the monthly minimum, I'm going to have a mortgage over the age of 70. And they're like, I don't want to be in that position. And I want to be smart. I don't want to let the lender win and, end up, thinking about it a lot later in life and paying them more interest than I need to. So why don't I chip away? And the beauty of Sprive is that we do it for you. Our algorithm, you link your bank account via open banking, and then we automatically help you pay off your mortgage faster and chip away. With one tap, the money goes straight to your mortgage lender. So you also have control. So if, a given month you've gone to town and you spent all your money on holidays and nice handbags or whatnot, then a lot less money would go towards your mortgage. Whereas if you've done a good job and you spent less and you've saved compared to normal, then a lot more will go. And you set the limit. So it will never kind of impact your lifestyle more than you want it to.
You mentioned that when you tried to overpay your mortgages and you just made the transfer to the mortgage account, it wasn't counted as over repayment. Did you manage to negotiate that with your bank? And how is it now working with Sprive?
Yeah, it's a good question. So, no, it's very clear when you read the fine print that, you need to contact them. So it's essentially my mistake. So there's no
They
room
got you.
for negotiation. With Sprive, we are very focused on that. Like, we know how to make overpayments inside out. We've been focused on this for quite some time now. So each lender works very differently. And so, we've got it all kind of coded into our technology. And, for most lenders, where they do require you to contact them, we have a task. So we don't let you pay any money to your lender until you've made that call and told your lender that I want my overpayments to essentially pay off my debt and help me become mortgage free faster. So we guide you through that process. So if you don't know anything, we give you the number, we tell you what to say, we make it super easy for you.
It's great that you do the whole financial education. Would you say that there is a conflict of interest between the lenders and people?
I think if you ask the average person, do you want to pay your lender hundreds of thousands of pounds in interest over your lifetime so that you can live in a nice house with your family? I think most people would say no. But obviously, there's nothing for free. The only reason you can live in that property is because you can afford to buy the property outright. And so you had to borrow. I think we live in a challenging time where property prices are just rising and rising, and comparable to salaries, there's a big disconnect. So I think there is a disconnect because the property lenders will continue to borrow. They continue to make sure their shareholders are happy, and it's a competitive space. There are a lot of lenders out there. There are a lot of products out there. So it's not easy to make money on these products as well. So I think there is a disconnect, and there always will be.
Jinesh, you wanted really badly to get a house and a mortgage. And then, ironically, as soon as you got the mortgage, you wanted very badly to get rid of it. What was your motivation behind?
So I wanted to get my own home because I've been obviously living with my parents for a long time, and I just got married. So we wanted our own personal space. I think that was important to us. So that was the motivations in terms of moving out, getting our first home. Even though I had a fairly good job, my wife has a good job too, we couldn't afford a property without getting a mortgage. So we had to, I think the maximum we could afford was a 25% deposit. So the mortgage was a necessity. There was nothing we could do. But what I did know is that every month we would have spare cash. So it was just a matter of making sure that we prioritized where we spent our money. So there were certain things that were important to us. So the annual holiday, as an example. So we always knew that we would have some money and make sure that we go on a lovely holiday because we both work really hard, and we felt like we deserved one. But besides that, we were quite careful. We tried to not spend money on things that we really didn't need. And the way I earned my income, I had bonuses. So once a year I'd get like a lump sum payment. And so what I'd find myself is once or twice a year, I would make a big overpayment towards my mortgage. And the real change in behavior was when I got the mortgage offer document. And I remember reading, and it's saying for every £1 that I borrowed, I would pay 50p in interest. And it showed the amount that I would pay in interest over the 25-year mortgage that I'd just got. And I was pretty shocked because I thought, well, interest rates are low. Why am I paying so much interest? And so that kind of got the ball rolling. And I sat down with my wife and I explained, look, do you really want to be paying this much interest? We have, disposable income. Shall we just get rid of it? I also didn't mentally like the idea of having a mortgage. I've always wanted to start my own business, and our mortgage was over £1,600 a month. So it was a fair amount of cash. And I knew that if I, say, for example, like I have done, started Sprive, I haven't earned anything in the last 2 years. So if I went to my wife and I said with a mortgage that, look, I'm going to quit my job and I'm not going to earn anything, then I think the answer would have been, you're having a laugh. You're not doing that. And, we've got responsibility, especially because, I have children too. So the mortgage has given me better control of my life. The fact that I didn't have a mortgage meant actually not earning anything for 2 years doesn't have as much of an impact. And I'm in my mid-30s, and the way I look at it now, I've got no mortgage and I've got the next 20 to 30 years to take risks and build wealth. Whereas if I had a mortgage and and I had those monthly commitments, then it'd be a lot harder for me to take risks and see what I could accomplish.
So your story reminds me kind of my story, except that I never had a chance to be homeowner and get the mortgage because I directly started my business. However, I can definitely see myself in how much you want to be debt-free and financially free in order to do what you want from life. So we both worked crazy hours in the investment banking world, and we're subject to all the corporate politics and the importance of tradition in keeping things. And often the thing that prevents people from doing what they really want from life is just the need of financial security and financial stability. And when you know that you're off mortgage and you just have cut your biggest monthly expense, it frees up so much possibilities. Was it your motivation to get debt-free?
Yeah, completely. I have no plans to get another mortgage. For me, it's all about now that goal of financial freedom. I like the idea of being in complete control of my life and how I spend my time. So now it's all about, can I build wealth, generating income and a lifestyle that means that I can, if I wanted to, hopefully one day just travel and, still be very comfortable. Or if, like I've done, start my own business and kind of intellectually challenge myself. The notion of not having any debt means that ultimately I have that freedom. Now, if I borrow, I want to borrow in a manner that allows me to generate more income as a result of me borrowing that cash. Whereas with my mortgage, it was if I'm borrowing, but I'm borrowing so that I can have a roof over my head. And if I can't afford those monthly payments, then they will take my home away. And I didn't like the idea of that. And I knew that if I wanted to take bigger risks later in life, then the first thing I needed to do was get that mortgage out of the way.
Financial freedom. We're all about financial freedom at Nova Money. And we try to inspire people to get that mindset of building your freedom over time, building wealth, and liberate yourself from consumerism and all the things that you don't like in life. And I remember at the time, I had the idea and the concept that being rich means having a lot of money. And the more time passed, the more I realized that actually being rich means doing what you want in life, which is very different from having a lot of money. Because I'm sure you also had a lot of colleagues that made a lot of money, especially when you go high up in the managing directors. I don't know how they were at Goldman Sachs, but mine were not necessarily looking very happy and fulfilled on a daily basis. And they probably made more money than both of us combined times a lifetime.
Yeah, I completely agree. I think if I loved money, I probably wouldn't have taken the risk and left Goldman Sachs because I was earning quite a healthy income without working as hard as I am now. In terms of, launching a startup and building something from the ground up is tough and you don't earn anything for it. And the likelihood of it failing is also quite high, right? Most startups do ultimately not succeed and fail. So for me, the primary driver isn't at all the money. It's to be challenged and seeing what I can build. And ultimately you want to create, financial freedom for yourself. But for me, the most important things are looking back and saying, did I do the best I could? Did I challenge myself? Did I push myself? Family, I think, is very important. So one of the big things I found when I was in banking is I'd never see my son. When I left in the morning, he was asleep. And when I came back at night, he was asleep. And I knew that if I did my own business, then I'd have a bit more flexibility. So if I do want to pick him up from nursery, I can do that and then work a little bit later in the evening. I have complete control. And I think that's very important. It is to me. And I don't think money is everything, but I think control over your lifestyle is super important. And some people may want to just travel, and you don't have to travel like you're Bill Gates or, you live in these 5-star luxurious, hotels. It might mean that you have enough money coming in to be able to fund and really experience the countries that you visit. I know some people who've done pretty well for themselves and they just do charitable work. if their goal was just making money, they would be focusing on other ventures, but they spend 10, 20 years of their life giving back once they've attained financial freedom. So I completely agree with you. I don't think money is everything. I think ultimately sometimes money can actually bring unhappiness, make you more unhappy. I see it happen all the time.
There's actually a very deep study from, I don't know if it's Harvard or one of the top US universities. And that study said that people, when they earn more than something like 4K per month, earning more starts to make them less happy. Did you have that same experience?
I think I'm not someone who buys lots of luxurious things.
You're not into consumerism?
No, not at all.
That's interesting. What do you think keeps you away from consumerism?
I think it's probably my background, my upbringing. To give you some context, so my grandfather grew up in India, and he had no education. He lived and worked on a farm, and he actually became an entrepreneur and kind of built his wealth and sent his children to private school, and they got a fairly decent education. But then my dad moved to this country, knowing no one, with £50 in his pocket. And he then had to kind of prove himself and build his wealth. And growing up, we didn't have a lot of money, but we did prioritize. So all the money that we did have, he put it in sending his children to private school education. And so there are certain things that are very important to me, but I don't think I had birthday presents growing up. I can't remember a year where, I was unwrapping presents, and we didn't celebrate Christmas. So that whole notion of getting lots of gifts and stuff wasn't something I grew up with. And I remember my dad giving me a Game Boy, which is like this, I don't know if people know, but it's a kind of electronic.
I played Game Boy.
Yeah, it's an electronic device that, came out when I was quite young.
We're old now.
And that was like amazing for me. That was, I really appreciated it because it was so rare for me to get something, and I knew how expensive that was, and the kind of the sacrifice that my parents made to be able to give me something like that. Because I've been brought up like that, I think that's kind of had a real influence in me, and I'm not someone who invests and puts money in designer clothes, or I feel like if you can't afford something, then you don't buy it. And occasionally I'll kind of spoil myself, and most of my income, if I have income, even when I was working in the city, I love holidays and I love eating out. So that's where essentially my money goes. Everything else I don't really spend money anywhere else, to be honest.
Do you think it's that upbringing and that grit that you got that really shaped your mindset towards building your wealth rather than pursuing consumerism?
Yeah, completely. I think I've seen my father and my grandfather being very careful with money and using the money wisely. And I've seen both. I've been fortunate to see both how they've used that money to really grow their wealth and take the next generation to a much more fortunate position. So that mindset, I also have that mindset. Now that I have children, I'm so focused on, can I take myself to the next level so that I can provide even more of a better financial position and a better kind of well-being for my future generation that's now growing up. So I think it's a big part of my grit and determination to achieve and improve.
There are a lot of people who dream to be debt free, to pay off their mortgages, to pay off their credit card, to taste the sweetness of financial freedom. But unfortunately, it's hard nowadays because there's so much temptation to spend, to have a lifestyle that is above your means, because the possibilities are just infinite. What would you tell to these people who would like to change their mindset?
Changing mindset is not easy. I think it's one of the hardest things to do. I think you've got to start small. You've got to set small goals and then start to see if you can make that happen and make incremental changes. I also think being very conscious around who you're surrounded with. So if you're surrounded by people who spend a lot of money, like going out, like eating out, like partying, etc., then you're going to do the same because the people around you have that similar mindset. if you surround yourself consciously with people that are similar in terms of they save a lot, they don't spend a lot, their goals are to be debt free quicker, achieve financial freedom, then you find yourself actually emulating them, and it doesn't become as much of a big deal in terms of trying to keep up with the Jones, because the people around you aren't interested in that. They're interested in other things. So I think, setting short-term goals, I think is a good way of changing behavior. I also think just surrounding yourself with the right people that are got similar goals and trying to stay away, if you can, with people that will kind of drag you down is probably my top tip.
I remember I had colleagues, whenever they were going out, you can be sure that you're going to spend at least £100 on anywhere, be it like for lunch, for dinner, for drinks. So did you make some very tough decision of not going out with some groups of people and select friends who are more frugal?
Yeah, I think when I worked in banking, you get some people that will forget £100, they'll spend £1,000 on a night out. And, getting tables were very important, and buying bottles of, X, Y, Z. And for me, I just felt that it wasn't a good use of my money. I was working very hard in the city, and to throw money like that, it just wasn't something that I could do. And so, I did it once. And then I was like, I didn't really enjoy it because I thought more about the money than, the time that I had. And if I compared a good night out spending a lot less money, to be honest, I had just as much fun or more fun, and I spent less money. So why spend that type of money and spend more money and do things when I wasn't getting much value from it? Because I do think you need to take a step back and say, when you spend your money, what value are you getting from it? And if you're not getting maximum value, then you're not using your money wisely. So, I've definitely seen that in my personal experience.
I don't know about you, but when I feel like I'm wasting money, I can see myself throwing away all the fruits of my work, all the stuff that I could have done, invested, paid off debt, into this little tiny table, which is ridiculously overpriced. And for me, it would completely spoil my evening.
Yeah, I think I'm similar. I think, I don't think it would spoil my evening. I mean, I do it from time to time, but what I do from time to time, I might spend £100 on a meal. And for me, that's a lot of money. But you can go to a perfectly nice meal and spend
better than 1,000.
Yeah, better than 1,000. But you can, and obviously when there's like birthdays or there's anniversaries, there's times where you should, why not? Because you want to make sure that
these are celebrations. I think we're talking here about like the weekly habits.
But your regular habits, etc., etc. I think for me, it's exactly that. I think it's about spending it wisely. And I am someone, even though I was in a fortunate position, I would look for the discount codes if I can and use things like Quidco. And it feels good to just save a little bit of money and to be a little bit smart. And even mortgages, so many people don't shop around. I read a stat that 1 in 5 people accept the first mortgage offer that they see. And I think it's 50%,
Wow.
50% of homeowners switch with their existing lender because it's easier. It might be easier, but most people's mortgages are their largest household commitment. And if someone sat them down and said, spend an extra hour of your time or 2 hours of your time just doing a bit more research and educating yourself, and that could save you, I don't know, £2,000 or £3,000 or £4,000.
If only they knew.
Then you would do it. I think they would. I think that, I think people don't necessarily understand.
For sure they would.
The cost of debt. And so I think there's a big part of it is education as well as mindset.
How much do you think people are wasting by just taking the first lender offer and not shopping around to get the best mortgage deal? I think over a lifetime, how much do you reckon it would cost them?
We've calculated, I think we have it on our website, £4,000 a year is what we're seeing with a lot of people that don't do their research or they don't get a good advisor. And that's why we built Sprive, is we want to create an algorithm that helps you make sure you're always on the best deal. The beauty of our product is at the moment we're helping people pay off their mortgage faster. But through that process, we get access to their spending data through open banking. We get access to information on their credit file. So we get access to their mortgage information. We get access to, with their consent, we get access to their property information. And this is all the information that essentially a lender uses to underwrite a mortgage. And there's about 10,000 mortgage products on a given day. So we do a lot of the calculations to basically help people make sure that if there's a better deal that they can get, that we help them kind of make that happen. And I understand, like, it's very opaque at the moment because you've got so many lenders, you've got so many different products, you've got so many different fees to try to like calculate all of that.
It's made very complicated.
Yeah. And then work out which out of these 10,000 deals, which ones can I actually get? Like a normal person actually can't do that calculation. I actually would say a lot of brokers can't do that calculation because it's actually quite complex. And so, at Sprive, we're just trying to build technology that just does all the maths for you and just presents it in a very simple way. And so that's kind of, I think the more the mortgage market makes things easier for consumers, the more people will save. And at the moment, the market isn't there. Like, it doesn't matter who you look at, there isn't a simple way of getting that confidence that the deal that I'm getting is the best. And I love to be able to be in a situation where through the Sprive app, if you can get a better mortgage by going directly to the lender, I'd rather tell people, look, we can't offer you this because this is a direct to lender only type deal, but this will save you more money. And we earn nothing, but we've helped the consumer because we've told them this is the best deal. And I really want to get into that kind of space where we generally just are very much focused on helping homeowners pay less interest.
Jinesh, I have a last question for you. Your whole business is to help people get rid of their mortgages and pay it early. What about people who don't want to pay it early and prefer to reinvest their extra income to build more assets? Is it something that you have done? Is it something that you hear some of your customers are doing? What do you think about it?
Yeah, so when we launched in closed beta last October, we started interviewing a lot of our early users and we started trying to understand their goals and their motivations. And one of the questions we asked is, do you invest? And what we found is a huge chunk of people say, yeah. So they want to pay off their mortgage earlier, but they also want to invest some of the money. So in my mind, I was quite surprised by that. I thought maybe it was like one or the other. So you either want to pay off your mortgage earlier or you invest your money. And in reality, I think a lot of people will do a combination of both. I think it's a bit of diversification. I think, my personal experience with investments, I have invested in stocks and in funds. I've even invested in a bit of crypto. But
I make money.
I bought Ethereum and I sold it before it started to increase again. So I could have made more money, but for me, I've just felt like it was the right.
You played the game.
Yeah, I made some money and you just don't know where these things are going to go. So I got out. But, I think with investments, I've made money and I've lost money. I find that I work long hours, and when I was in banking, I was working 70 plus hours, if not more now with Sprive. So I've struggled to find the time to invest properly, and I don't like having an IFA. I don't think they add, too much value, and the amount of fees that they charge, I don't really necessarily agree with. So I don't think investing is easy. I think it's not guaranteed, and so I think it's good to do it, but I also think you need to know what you're doing. I think a lot of people, for example, are investing in selling cryptocurrencies, and they're doing it because everyone else is doing it, and they don't really understand what they're investing in. And I'm a believer that if you're going to put your money somewhere that you spend a lot of time and energy earning, you need to understand where it's going and what the risks are. And so with mortgages, the great thing is that you're definitely going to be, earning more, generally speaking, than the money sitting around in your current account. Especially some current accounts are paying hardly any interest.
Yeah, so banks charge much more interest rate than what they give to deposits.
Exactly. That's how that's their business model, right? That's how they make money. Mm-hmm. And so exactly with overpaying your mortgage, what rate or return you're going to get. It's tax free. So I think from that side of things, I think it's good. I think there's benefits from being able to pay off your mortgage earlier, which we've spoken about in terms of just control of your lifestyle and getting on top of things and setting yourself up for later in life. In terms of advice to people is, if you're comfortable with investing, then definitely invest your money and diversify. I think also paying off your mortgage, you are investing in property. So I have a mortgage-free property, but my property has increased, significantly in value since when I first purchased the property versus when, where I am now. So just because you're paying off your mortgage doesn't mean that it's, there isn't an asset. Your home is an asset and it has value. And the last year you'll see that the property prices have increased by like 11%. So obviously, investing in your home is a form of investing too.
Yeah, it is the biggest asset that people would typically have across their lifetime. Great. Jinesh, thank you so much for sharing your story and all your insights about the mortgage industry.
No, thanks for having me. It's great to be here.
Our pleasure, and all the best.
All right, you take care.
Thank you for listening. I hope you found this episode enjoyable, inspiring, and educational. In this era of instant gratification, it is more important than ever to train our delayed gratification muscle. So keep learning, keep improving by 1% every day. You may not see the results right now, but this is a secret of all the successful people I've met. Please help me spread financial education by sharing this podcast with your friends and community. I would love it if you could also leave us a review. It really helps the show. Now, I would like you to forget about all the advertising that is being pushed to us on a daily basis and think about your personal financial goals. What do you really want to achieve with your money? If you have financial objectives, then check out the Nova Money app. Nova is an AI that will show you how to set financial goals and how to achieve them. A plan is only useful if you can follow it. That's why Nova will send you daily motivational messages to give you the strength to ignore the daily temptations of spending money and stay focused on your goals. Like other budgeting apps, Nova connects all your bank accounts in one place to give you the full picture. The difference is that the Nova AI will do all the budgeting and tracking for you. The second difference is that unlike many free personal finance apps, we don't sell users' data. All your data is encrypted and will remain completely private. Make sure that you're investing in your financial education. Make sure that you're building your financial freedom. And I'll speak to you in the next episode.